We are more likely to spend windfalls, take more risks with it, and treat it more as discretionary income as opposed to earmarking it for any outstanding obligations that we may have. My name is Short Sardakis. I'm an associate here at Hirsch Financial Services. And today we're going to talk about why our tax refund feels like free money, even though it's not really free money. So every year around this time, people are looking forward and they're excited to receiving this lump sum tax refund. And for many households, it's the largest check they're going to receive every year. And so today we're going to talk about the underlying behavioral mechanisms behind how we treat tax returns and maybe some actionable steps that we can take to improve how we treat tax returns in future years. But first, what is our tax return? A tax return is essentially the byproduct of too much being withheld on our weekly, bi-weekly, whatever paychecks. So every time we get paid, we have taxes withheld, we have Social Security and FICA withheld. But when we withhold too much, we receive this tax refund at the end of the year when we go to file our taxes every April. Or if we have not withheld enough, then that would lead to us owing taxes at the end of the year. The way we treat tax returns is typically that of a windfall. In that place of the concept that was first introduced by Richard Thaler called mental accounting, which essentially means that people will categorize money differently into different psychological buckets depending on its origins. So instead of treating all money as equal, they separate it into mental categories such as salary, bonuses, tax refunds, investment gains, windfall, etc. It's kind of similar to how we bucket expenses like household expenses, discretionary vacation funds, or going out to eat funds, utilities, entertainment, groceries, etc. So even though every dollar that we receive is identical in nature technically, the source from which it came usually changes how we treat it, how we spend it, how we save it. So what does that mean for how we treat tax refunds? Well, because they are received in such large lump sums, we often categorize it as discretionary money. We treat it as windfall money rather than earned income money. And again, this is consistent with the research that was performed by Thaler. Thaler also later would incorporate this concept into what he termed as the behavioral life cycle hypothesis, which suggests that people would divide money into categories such as current income, current assets, future income. And to the point of the future income, we often tend to already have this money spent even though we never really have received it yet. This lump sum tax return also falls into the category of what we call the windfall effect. Behavioral finance research shows that individuals tend to spend unexpected money differently than how they spend regular income. This would be things like tax refunds or bonuses, lottery winnings, gifts, etc. So it typically means that psychologically speaking, this unexpected money feels less connected to financial obligations like debt, savings, investments, etc. We are more likely to spend windfalls, take more risks with it, and treat it more as discretionary income as opposed to earmarking it for any outstanding obligations that we may have. Again, savings, investments, debt, etc. So even though the tax refund is technically money that's ours and we've already should have accounted it for, because we receive it in such a lump sum, it's enough for us to treat it as discretionary money, similar to that which is categorized by the windfall effect. Why does all of this matter? Well, when someone consistently receives large refunds, it typically means that they're having too much taxes withheld throughout the year. So that kind of creates a trade-off. On one hand, we receive a large refund in April, but on the other hand, we could adjust our withholdings this way we can have more money within our paycheck throughout the year. In the case of the latter, this may mean that we have more money to invest earlier, we have more money to pay down our debt sooner, and we can overall just improve our monthly cash flow, bills, savings, more expenses, etc. The research shows and suggests that when people receive money earlier and allocate it intentionally, they may see better financial outcomes overall and over the long term. Now, on the other hand, on the first hand, refunds can be helpful. Research shows that commitment devices can be helpful to individuals when it comes to saving money. Commitment device is essentially a mechanism that help people follow through on intentions despite any kind of short-term temptations. And this would be things like automatic retirement contributions on a regular basis, payroll deductions or automatic savings to an investment account or savings account, and then treating tax refunds as forced savings. Essentially treating that money as if the money never existed and we just put it into our savings or put it towards debts or put it towards investments. Implementing this strategy can definitely help a lot of families intentionally use refunds for paying down debts, building any kind of emergency savings, funding larger planned expenses. So if we treat these tax refunds with intentionality, that may also be able to help people with their financial long-term success, even though psychologically speaking, it's treated as a windfall. Treating our tax returns in this way can definitely help a lot of families kind of start to build good financial habits by using that tax refund to pay down debts, using it to build emergency savings, or even using it to help fund large expenses like a vacation or a wedding. And so what are the big takeaways from all of this? Well, first things first is we want to review our withholdings. We want to speak to our tax professional and review our withholdings with them and see if it's appropriate for us to continue how we're withholding or if we want to make any kind of adjustments into the future. The second step would be deciding how we want to treat our tax refund in the event that we decide to continue with our withholding as is. On one approach, we can adjust our withholding, so this way we can keep more money throughout the year. And the second step is once we figure out how we want to adjust, or if we don't want to adjust our withholdings, we kind of follow each of those approaches. So if we do adjust our withholdings, we want to make sure that we know how we're going to spend that additional money throughout the year. Or if we decide we're not going to adjust our withholdings and we're going to continue to hopefully get these tax refunds at the end of the year, then we want to make sure that they're intentionally allocated as a structured savings tool. And that gets to the third step. So we want to make sure that we plan for our refund before it arrives. Research suggests that pre-committing decisions reduces impulsive spending. These can include strategies like implementing emergency savings, using the refund to pay down debts, using it towards contributions towards investment accounts like retirement account or any kind of after-tax investment account. Looking at this concept through a behavioral lens, which is something I was formally trained in, reminds us that money decisions are rarely just about math. It's about how we treat things, how we feel, how we think. It's about the psychology of money. And whether we prefer receiving a tax refund at the end of the year or adjusting our withholding so we get a little bit more each month, the key to making that decision is being intentional about it rather than just letting these decisions happen automatically. Thank you for watching. If you have any questions, leave a comment below, and I look forward to seeing you in the next video. Thank you so much.